I'm Jesse Mackey, CIO of 4Thought Financial Group, and this is 4Thought's multi-method investing market perspective as of September 20th, 2022. On June 17th, the S&P 500 price return index reached a maximum intraday drawdown of 24.5% from its January 4th peak price. After a partial recovery and a subsequent relapse in the time since then, it sat 19.07% below the record as of the close of business yesterday. The initial indication of a bear market on May 20th, based on the technical intraday definition of a 20% plus decline, has very significant implications for portfolio management strategy. The history of the S&P 500 since 1950 reveals that once bear markets have been identified, in which a 20% plus decline from a record peak has occurred, they've continued for an average of an additional 4.61 months and have experienced an average additional cumulative loss of 16.56% until the trough is reached. However, 6 out of 13 instances of a bear market turned around within 1 month after it was indicated, some as early as the same day, while all others lasted longer, up to a maximum of 1.63 years. For long-term investors that can afford to wait until a recovering upturn in the market cycle, such data calls for aggressive deployment of cash and cash equivalents into stocks and bonds in this case, both immediately and in the months following confirmation of a new bear market. As of today, exactly 4 months have already elapsed since the bear market indication. Therefore, long-term investors should consider an immediate deployment of 100% of any idle cash, not needed for short-term liquidity or expected upcoming spending. There's no longer any need to wait for further declines or to use a dollar-cost averaging program for idle cash, as was the case in the last 4 months. This should be discussed with your advisor to confirm appropriateness for your situation before taking action. Based on analysis of the complete historical market type data set using our multi-method adaptive algorithmic process, we're now allowing overweight allocations to strategic asset allocation and underweights to liability-driven investing, opportunistic investing, and selective concentrated investing. From a probabilistic analysis perspective, valuations tell a story that's positive for most stock types, but even more favorable for some bond types. On this basis, most stock types now range from slightly to moderately undervalued. By contrast, most bond types are now range from significantly undervalued to deeply undervalued, as in the case of investment-grade corporate bonds. Investment-grade corporate bonds now reflect the most attractive pricing relative to the alternatives, while U.S. mid-cap stocks are the least attractive. Emerging market stocks are the worst-performing publicly traded broad asset types so far this year, while U.S. short-term bonds have been the best, despite their own negative returns. Against this backdrop, the outlook for stocks is now highly positive in the intermediate term based on the overall aggregate of a historical market type data analysis and quantitative probabilistic analysis. I hope this was helpful. If you have questions or would like to discuss what this means for your particular situation, please contact 4Thought at 516-300-1617 or at info@4tfg.com. And don't forget to subscribe to our blog feed and our YouTube channel. Thanks for watching, and see you next week.